actually really do believe in long-term investing. Personally, I do try to sort of set it and forget it, but it's really hard to do that as a technical analyst because I am so close to the market.
Hi, I'm Ed D'Agostino from Malden Economics, and today I'm speaking with one of the market's favorite technical analysts, Katie Stockton of Fairlead Strategies. Katie shares her research on the U.S. stock market, emerging markets, energy, Bitcoin, and more this week on Global Macro Update. Hey, Katie.
Hi.
Thanks for joining us.
Good to be here.
Yeah, it's been a while. I really appreciate you taking some time. I thought of you the other day. I saw your interview with the Ritholtz guys, Compound. That was so good.
It's so fun, I have to say. They just do such a fantastic job and a nice balance, I think, between sort of the current events, right? And a deep dive into the process.
Yeah, and they're fun. I'm a big fan of that channel. So I'm not going to duplicate that.
No.
It kind of snapped me into, oh man, I've got to get Katie on because here's what I'm seeing. I'm seeing so much dispersion of opinion in the macro landscape. All of the macro analysts that are out there. I mean, there's so many charts flying around social media right now, and at this point you can build a chart to prove the ultra bear right through to the ultra bull case.
That's
right?
What
Like
the
it's
market,
so confusing.
Right?
Yeah. But it just seems like it gets more diverse of opinions. I'm hoping you could ground us a little bit because you're a technical analyst.
Yeah. And I mean, that's indeed what we do in a way, right? Where it's all price-based analysis, and not to be too cynical, but every bit of information boils down to a buy or a sell decision at the end of the day. And so it manifests itself in price. And price, we know, moves in trends. So I think it's just a matter of very simple trend following at this point. And, is demand, overwhelming supply, et cetera. So it is really that simple. Now, I see all the same charts you do, and it does make a market. It's what creates both sides of that, the supply and demand. And, honestly, from a technical perspective, we don't get caught up in those types of narratives as much because it really is math, right? We're trying to measure trends and their strength. So there doesn't have to be an explanation, frankly, for why that trend is in force. It can just be in force. And, we could spend all day and then some trying to explain everything. But at the end of the day, it really is just a supply-demand dynamic.
If you're looking at just, say, the S&P 500, like let's just start broad and then we'll kind of get narrowed down into sectors. What are you seeing? Because in the macro world, like the narrative seems to be evolving that we're going to end the year strong and then everybody rolling into 2025 sitting on fat gains, and they don't want to realize them this year and pay the taxes, but they'll hit the bid in January of 2025.
It's a good point. When year end closes, right, and now we're getting pretty close to that, it does relieve the market, or well, relieve isn't probably the best choice of word, but it takes away some of those influences, right? So that the people that are delaying tax, sort of issues, the window dressing, I'd say that goes on for institutional holders of the market who feel like they need to do this performance chase at year end, having underperformed. And I would argue that that's probably pretty prevalent right now this quarter with the narrow leadership just recently since the election of the mega caps. And not that that's a totally new phenomenon. And then also the so-called Santa Claus rally, which we don't give too much weight to in our work. But listen, it is at times a thing. And so all of those things go away, right? So kind of releases the market to pull back or at least remove some potential demand into year end. So we are of the belief that Q1 is more likely to see the correction, not between here and year end. More and more, that's becoming not that big of a call because we're only a couple of weeks away really until year end. So I think we can almost safely say that we're seeing a strong finish and set our sights on the new year at this stage. And I think our messaging has been to hold off on new purchases unless you have a very specific catalyst to take advantage of. For me, a catalyst is going to be a technical catalyst like a breakout. And we're seeing a decent amount of breakout. So there's been a lot to do from a bottom-up perspective in the stock market. But for positions that just have good momentum and are, sort of steady as she goes, I would generally just wait to add exposure and even consider reducing stocks that have shown a loss of momentum, of which there are also a lot of those because the breadth hasn't been great. So even though the major indices have been pretty stellar, from a bottom-up perspective, you have a lot of names that have seen weekly MACD sells or moving averages roll over. So those might be candidates for reducing to raise some cash to be put back to work in the next corrective phase. Knowing that any kind of corrective phase, like you tend to see most stocks participate on the downside, no matter how defensive those stocks are. So we believe that in that type of environment, it's best to, pare back some exposure, ideally ahead of it, or just get hedged partially through it. From a top-down perspective. And we have so many avenues to do that these days. Inverse ETFs have been a great way to do it.
How do you feel about inverse ETFs? That's an interesting point you just made.
Yeah, no, I think they're a great option. I think ETFs have given us so many choices and ways to invest. And I think inverse ETFs are really a great option. I don't think you hold those for the long term, but as a temporary position to manage risk, well, what a great option to have, because it's not terribly sophisticated, right? Nor is the construction terribly complicated. So I think that if we just use it as a temporary hedge against existing exposure, it makes a lot of sense. There's a lot of products that you wouldn't want to hold long term, maybe some of those VIX products too, you wouldn't think about in that framework. But for these temporary hedges, they can be really very value add. There are some products that have gotten so sophisticated to the point where if I can't understand it, then I generally don't want to invest in it. So there's that, but that's as much a me problem as it is a their problem. So
when you're talking about all this, what sort of time horizon do you and your clients usually work with? Because, like we started out with the Ritholtz guys, right? When I talk to them or think about them, I think, buy and hold forever, right? They think in terms of years, if not decades.
Well, wouldn't that be nice, right? I actually really do believe in long-term investing. So personally, I do try to sort of set it and forget it. But it's really hard to do that as a technical analyst because I am so close to the market. But I find that really only on rare occasions in my own investing do I, tell my advisor, maybe dial back the high beta exposure, something of that nature. So I try to keep it pretty infrequent in my own investing. In our research, we cover all time frames. So we'll go as short as what does the next week look like, up to what does the next year look like. And we probably won't go out much farther than the next year because honestly, my indicators don't add much value beyond that. Because, if we try to say we have a 3 to 5 year time horizon, I don't know how people get that because, you'd think that they could change their mind, 3 to 5 times by the time 5 years is up. So, with the research, I would say we center probably around the intermediate term, which I would say ranges from about 2 to 4 months for us. So think of it about 1 quarter in the focus that we have in our research. And then we'll kind of tune that to the long term and the short term.
So with that in mind, so listeners can kind of have that for a calibration, let's dig into some sectors. And maybe we just start, like I got a little off track, the S&P 500. Just what are you seeing broad market S&P?
Yeah, listen, it is an uptrend. Nobody can argue that. So in its simplest form, we want to respect the uptrend. That goes from a cyclical and a secular perspective. So if you look at a monthly bar chart and you just throw a moving average, it looks quite good. Some of our indicators that show, if something's perhaps overextended upside or downside are showing signs of upside exhaustion, specifically the monthly DeMark indicators. Tom DeMark has a suite of indicators that we find very helpful in gauging trend exhaustion. And we do have some counter trend indications as of last month and this month on the monthly SPX chart. So that has us just kind of on the lookout, right, for any meaningful loss of momentum. The signals themselves, we don't necessarily react to, except we did sort of with those in mind, move to a neutral long-term bias. But our long-term in that case is about 6 to 9 months off of those signals in part. And also noting that momentum has downticked slightly on a long-term basis. So while it's still to the upside, it's not what it was in the earlier stages of the cyclical up move. So we feel that maybe a consolidation phase, it could be one that has an upward bias to it, but something that looks a little bit more sideways than we've, of course, been accustomed to, could characterize the next few months, and meaning sort of much of 2025. But we're expecting that 2025, the uptrend, at least on a secular basis, should be maintained. And that gives the opportunity for the market to post additional gains. I just don't think it will be what we've seen in 24 or 23. A lot of that is going to have to rest on the shoulders of these heavyweights, which are such a massive component of the S&P 500 and other market benchmarks that we're using.
I think it was an analyst from Schwab earlier this week posted a chart on Twitter where he took NVIDIA out of the S&P 500 and compared it to the European stock market. And Europe's ahead of us without just NVIDIA.
Isn't that wild?
Which is just crazy.
It is wild, yeah, especially with the long-term underperformance from Europe. And that you make sort of a point also, if you look at the global breadth, so we always talk about breadth here in the US, global breadth has been pretty lousy as something, not to say that we get a leading indication from European markets for the US market, but we feel that the corrections that have unfolded there, mostly pretty orderly corrections, are something that will ultimately characterize the S&P 500 as well. And just this week, we decided that, and this is not for everyone, but in terms of relative positioning, that those international markets are poised for a relative bounce versus US. And it's just one of those sort of like underlying indications that things might tire out pretty soon. And that pretty soon could be just post year end.
Would that include emerging markets or strictly Europe? Or?
It would include sort of both the top-down EFA countries, top-down emerging markets, but in emerging markets in particular, China just has such a huge footprint. It's almost like the mega caps are to the US as China is to emerging market benchmarks typically. So for China, we do think actually a long-term bottoming process is underway there and still has time, can extend itself. But that's not shared by all the countries that we look at. Brazil, for one, is still very weak in terms of long-term momentum. So you had to sort of choose country by country, but China is really kind of the stalwart within the emerging markets.
It is interesting. Okay, so you feel like, to the extent you're interested in investing in China, would you be selective or broader exposure?
So I would say I always like diversification, frankly, but that's just me. I'm like more risk averse in that way. In China, I think you have to realize that you're still taking a counter trend position. So, that puts actually odds against you in a way, right? If you're buying something that's counter trend, but it's also opportunity. It's opportunity in that the first big move off a low is often the biggest and the most like fast and furious, but also just the long-term possibilities there, right? Of getting in close to a big bottom. But I also really think that a portfolio, whether it's international or otherwise, should mostly have components that are in long-term uptrends. So I'd want to have diversification for that reason alone, just because China is still technically, depends what you look at, but counter trend in the way that it sets up.
I'm kind of sitting on my hands personally on quite a few ideas that I have, because I just feel like there's so much, and I know this maybe doesn't factor into your technical analysis, but I just feel like with the new administration coming in, and with some of the things that sort of the pre-negotiations that are happening on social media by the president-elect, I just feel like there could be some whipsawing coming?
Yeah, there's definitely been a lot of talk, and I think the markets responded really well to it. I think there's just encouragement. You can see it because some of the moves have been concentrated in things that are really tied to politics, right? So maybe that sort of initial exuberance will go away. But that's a why, right? So it's not where my expertise will lie. It's more like what's happening. And we just don't have that real loss of momentum behind those trades yet. We have like a little bit of a downtick in the short-term indicators that we track. But so far, with the strength of the uptrend still intermediate term, like looking at the weekly MACD, the weekly cloud model, things of that nature, we don't want to fight against those indicators because we found that the short-term loss of momentum that we've seen over the recent months, it's resolved very, very quickly. And that could just be a sentiment thing, who knows? But we've also seen the market move from what we felt like was a higher volatility cycle that began early in the summer. And it's already kind of come out of that cycle, which is pretty quick. And it tells us that as much as sentiment might seem complacent, it could actually get more complacent. So, we're just being real mindful of those momentum gauges on an intermediate term basis.
Can you talk a little bit about the cloud indicator that you mentioned? Because I just looked at your latest chart deck, and that's one of my favorite charts, is when you sort of have that cloud indicator above or below the line.
Yeah.
I'm not technical.
No, but it's a good visual sort of indication. I don't think you even really need to be technically inclined to kind of understand it. The I guess calculation is a little bit of a mystery, but it's called Ichimoku. And there are a lot of components of which they're typically based on midpoints of price. So it takes almost like a moving average, but it's taking a high-low spread over history and taking the midpoint and projecting that forward. There is this interesting forward-looking element to it where you see the cloud extends ahead of price. And it does so by sort of a parameter that is also seen in the MACD indicator for one. So it's interesting that some parameters for the cloud model align with the MACD, and I'm quite sure other technical indicators too. And my guess that comes from the market calendar. And I think it's also standard parameters tend to be, to me, the best parameters to track for these indicators because there's more eyes on them, and more eyes could mean something that becomes self-fulfilling too. So we use standard parameters on the Ichimoku cloud, which is generally available. Like you could go onto a free charting software and generally find it these days. But it is really widely followed outside of the US, in fact. And it's a great gauge of the prevailing trend. And we like to use it primarily in a weekly bar chart. So that would be the cyclical trend. And then also a gauge potentially of support and resistance. In a trading range, it'll be a little bit less helpful or informational. So there's sort of environments in which we'll use it more or less. But we find it as a great gauge. And I'd say generally speaking, the cloud model on the weekly charts right now, it has been trending higher up until about, I'd say, sort of mid Q1. And then in a lot of cases, you start to see it flatten out. So with that forward-looking element on a weekly chart, you can get into kind of the beginning of the second quarter, and you start to see the clouds flatten a bit. And it just gives you this visual implication of more of a range-bound environment as we're getting from those monthly DeMark indicators. So if you reconcile those two, tools that we have in our toolbox, it feels as if there's enough of a reason to be more neutral over that time frame.
With technicals, though, Katie, I mean, if I got you in the same room with, JC Peretz and Tommy Thornton and some other technical analysts, and I gave you the same 10 charts, would you all come to the same conclusion?
Well, I think they're on some level, yes, because again, everybody has to agree that this is an uptrend. They might think it's an uptrend that's changing, right? So we might have different predictions or different takeaways, like in terms of how we position for the current environment. But generally speaking, I'd say we probably can agree with the historical trading, right? Technical analysis, in my opinion, isn't really predictive per se, but it's putting more probabilities in your favor. It's helping you identify prevailing trends and stay on the right side of them. And then it can help you manage risk within that context. So that's where I see the value more than just saying, okay, well, where is the S&P 500 going to be in 6 months? We're taking weight of the evidence and making a judgment for that. So we do have an opinion, of course, but that's an opinion that could change. And, so it's different. It's not super predictive. It's more about keeping these things on your side and knowing when you've got a challenging environment.
Yeah, that's what I was trying to get at, is there really is a experience counts, and there is an interpretive element to it that each analyst is going to at least do something different with the same chart.
I think you'd find that I would maybe be like a little bit of a brat about it, because I would make sure that the chart has my indicators. And so you would give me a chart that doesn't have my indicators, and I'd feel almost like I don't even know, So we get really tied to our own methodologies, and not one of those methodologies is really the best one. It's just a matter of coming back to the same tools time and time again that I think you can get the value. So think about it as a more systematic approach to technical analysis. And that's where I think people can really derive the value of the discipline by coming back to those same metrics, because again, it's math and it's measuring supply and demand. The problem, if you start to just look at, on Twitter or X, and you're consuming information that's sort of random from different providers, what that runs the risk of is confirmation bias. You're going to choose the chart that affirms what your beliefs are from whatever, a macro perspective or otherwise. And without the consistency of going back to the same charts, then you're losing some of the value, I think, of the discipline. And every technician who's a practitioner and publishing generally obviously have a methodology, and they're probably pretty narrow focused on certain tools.
So it's what you look at as well. And that can vary between analysts.
Yeah, for sure.
Okay, that's helpful. Let's look at a couple other sectors, and then I want to get into a discussion about your ETF. How are you feeling about small caps right now in general?
I mean, I would say in absolute terms, quite good. If you look at the long-term setup of something like the Russell 2000 index, you'll see a big sort of rounded base that's been completed and has resolved with new highs. So that's really compelling to me. It almost looks like we're getting not a cup and handle per se, but just this nice sort of carved out pattern. So I'm encouraged by that. And the Russell 2000 doesn't have any concerning sell signals right now on a long-term basis. The relative performance, which is what people often talk about when they're referencing small caps, they're thinking about them relative to large caps and building a position in an overall portfolio. I'm not terribly convinced that we're going to get sustained outperformance from small caps. So I'm not as encouraged, I'd say, from the brief phases of relative performance that we've seen at times over the recent months. There has been stabilization in the ratio of the Russell 2000 to the S&P 500, but I'd say it's too early to suggest that that's more than a counter trend move. So not terribly convinced that we'll get outperformance, maybe inline performance, especially if we get into a trading range. And yet longer term, I think the secular bull looks very, very healthy in the small cap arena. And the ability for breadth to spread out on the sector front or from growth to value to some degree is only going to help it.
How about energy, which has been beating me to a pulp lately, I have to admit.
Yeah, I like to like energy, but it's hard to like right now. I've got good friends in energy, but, and it's funny because that was the only sector for some time that we held in our ETF. So we had a few months during the bear cycle that we only had energy exposure. So maybe that's why I have like a special place for it. But right now it's just really not acting well. It has weakened momentum. It has really poor relative performance versus the broader market. We have new lows in the ratio. And you can't make much of a case right now for crude oil to go higher because it's just been so range bound. and has lower highs and somewhat weak long-term momentum. So it's tough to make that case. And then natural gas looks like it's building a base. However, it's hard to find an energy stock that really trades positively correlated necessarily to nat gas. They are out there, but they're hard to find. So it certainly doesn't take up the big component of the sector indices.
The midstreams have been just on a tear. It looks like they've rolled over a little bit too.
Yeah, I mean, listen, there are always like those pockets, right, of strength, and in absolute terms, they're going to all look better than they do in relative terms. And you can say that about so many, I guess, beleaguered sectors like the real estate sector. You would think it would look much more terrible than it actually does. So where you've had relative underperformance, there's still some pretty decent intermediate term trends. But that it's just a matter of finding the relative performance. And it just has not been in energy. It has not been in healthcare, nor staples, nor even materials or industrials. So it's been so concentrated of late to the mega cap heavy sectors.
It's just tech.
Well, it's funny. It's not just tech. It's actually communication services and consumer discretionary. So we have, I guess, Alphabet now. Meta, I think, is communications. We have on the consumer side, we have Amazon and Tesla. So it is tech, mostly, but then we have those components, and they're big components and big breakouts too that we've seen. So we have these sectors that have done very well right now in our recommended weightings. We are overweight only communications and consumer discretionary. Tech, if you look at it, it's interesting because as much as Apple has been very strong of late, it wasn't previously, but Microsoft also wasn't really great in terms of relative performance, but with a short-term breakout now. NVIDIA had been great, but lost a little bit of that luster. So overall, combined with weakness in relative terms and in a lot of cases, absolute terms in the semiconductor sector, tech actually has not been doing very well overall. So the broad-based tech indices, I'd say neutral relative performance overall, and it comes after a long-term uptrend. So the question will be, is this a neutral phase within a long-term uptrend, or is it the sort of beginning of a reversal lower? And when I look at the relative rotation graphs that we have, so these are called RRGs, and they're really interesting. Not my development, but this person out of the Netherlands, he's developed this really cool way to visualize sector rotation. And with it, you see these normalized views of the sector performance versus the benchmark you've chosen. In our case, the S&P. And you can see this kind of circular rotation around the middle. And if you look at a long-term version of these RRGs, it's pretty interesting because it shows both tech and communication services as being the most prone to rolling out of favor. And they're also the ones that are closest to their highs. They've just had these sort of downturns that look a little bit ominous. And then the ones that look most promising, surprisingly, are the defensive. So it's consumer staples and real estate and utilities, which is a little strange, but that's exactly what it's trying to measure. And what it's rewarding is that phase of outperformance that we had, remember, from utilities especially. It's rewarding that basically as a reflection of a shift in their downtrends in relative terms. That's pretty meaningful. So even though we've seen a good retracement since then, it's treating those as the start of bullish reversals in relative performance. So we'll see how it unfolds. But, I don't think the sort of mega cap sector concentration will be quite as prevalent in 2025. We've already seen it take a sort of a downtick from what we saw in 2023 in terms of that concentration.
Okay, let's talk a little bit about how you invest. Fairlead Strategies, that's your company, and you have an ETF. TACK is the name and the ticker, right? TACK. And if you pull up a chart of TACK, it looks pretty darn good. So what is it? What's it? Who's it meant for? How does it work? Unpack it for us.
The ETF business, we're pretty new to it. We launched TACK, which is the Fairlead Tactical Sector ETF in 2022, which was kind of interesting because that was a bear market cycle. And one of the primary goals of TACK is to limit drawdowns, sort of a hedged equity type of outcome, but to do it through asset allocation. So first and foremost, we're evaluating the sectors. So we're using sector spider ETFs for long-term characteristics, kind of a combination of what we've been discussing: momentum, overbought, oversold indications, and relative performance. We're doing that, but we're doing it using month-end closing data. So we're taking a sort of a step back. So really very long-term in the analysis. And that's how I sort of think in terms of investing too, because you don't tend to benefit from getting caught up in the noise, right? So when we have corrective phases, it doesn't tend to benefit you terribly much to reposition a whole lot. It does make sense sometimes to hedge partially and to reduce exposure, but you don't want to make these dramatic moves typically, because just like the guys over at Ritholtz believe, the long-term buy and hold tends to pay off, right? But if you can have long-term buy and hold, which is sort of our goal, but then also have a way to limit drawdowns at times, I think that's even better, because it's and to do so systematically, where you have these models that are running that are telling you when to get back in from sort of a reduced position. That's hugely helpful, because we're all human and we all get jarred by things like COVID, and it takes us a long term to psychologically get back to the place where we feel like we can invest. And so the models can help us take out some of those emotional issues and get you back to that full invested position when you should be. So TACK right now holds all sector ETF positions. We equal weight our sector ETF positions. That's very intentional. It's to reward the sectors that even if they have, a 3% weighting in the S&P 500 perhaps, we're trying to reward those sectors if they're showing some momentum and relative performance. There is a catch to that, where with technology's footprint being about, 33%, so about a third of the S&P, if the leadership is really concentrated in technology, then that's going to be a hit on equal weighted strategies. So we always tell people TACK is a core long position that you don't have to worry about generally. And then in a very strong tape to supplement it with the technology positions that you're probably most excited about anyway. That's a great strategy. So TACK as a core, and then satellite positions in technology, or just kind of higher beta growth type of exposure. And so that's what we've recommended. And it's suitable for honestly anyone. I sort of developed it with a lot of the advisors in mind who subscribe to our research. And we're trying to do a sector rotation strategy, but incurring a lot of taxable events in doing so, and an ETF wrapper around a strategy. And it doesn't fully resolve that, but definitely improves the tax issues that can come with a high frequency strategy. And then also just didn't have the time, honestly, in the systematic approach that can lead to success. And so TACK is doing that for them. So it was a solution for the advisors. And I think an end user is someone who's maybe on the verge of retirement or in retirement and just can't stomach those drawdowns. But then again, I also, buy it for my kids, because it's something that will be there to participate in strong markets, and it will help preserve, during drawdowns. And that's really interesting to me. And to do so with like a lower beta and lower correlation to the S&P 500, it's hard to find something like that.
It's an ETF of ETFs, essentially. But when the market or sectors break down, what other options do you have? I mean, if you're getting out of stocks at some times.
That's right, because we don't want to be in the sectors if they don't have decent long-term momentum. We'll live through corrections in some of them, as long as it's not a major detriment to our indicators. But we don't want to live through those drawdowns. And there are those, just like in 2022, when we had a big bear market cycle that affected almost all sectors outside of energy. And so we went to almost a full, what we call risk off exposure. So in addition to the 11 sector spider ETFs that we're considering for the portfolio, of which we'll invest in 8 at our max exposure, we will allow ourselves to move into 3 other ETFs to sort of manage risk. And those are representing short-term treasuries, long-term treasuries, and gold. And it's that collective sort of diversified risk off piece that's helping us limit the drawdowns. And it's, again, something that a lot of advisors, it's their goal to do that, and they were trying to do it themselves, but it requires a lot of activity. So it gives you that nice kind of, it's not a buffered product, right? And there's no guarantees around it at all. But we have seen it prove itself really nicely in those drawdowns by more than halving the drawdown typically in the S&P 500 and improving, even relative to the benchmark, which is called the Morningstar Moderate Target Risk Index. And it's like a 60-40 proxy. For those of you that are invested in 60-40, we know that, it's very traditional, but I think it's being challenged as a static type of portfolio. So it's almost like we've created a dynamic version of that.
I think that's important to highlight is the active element, right? This is an active ETF. So you've got the low cost structure of an ETF, a retail investor, individual investor. I can get on my brokerage account and I can put an allocation to TACK and I get all the low cost of an ETF and I get you, right? Like I get you running the portfolio. It's kind of amazing.
It is 100% systematic unless there was some, extenuating circumstance. So we have discretion, but we've developed a model that we're really confident in. And so it's model driven. We basically took our technical methodology and created a rules-based system around it. And then of course, back tested it like crazy, like everyone would, to get the additional confidence in what we're doing. And it's that systematic approach. And then also the active/dynamic piece that I think can create what we, at the end of the day, all want, which is something that we can truly buy and hold, right? It's like a buy and hold in and of itself, but something that will do the work for you. And I agree with you on the ETF. I mean, it's low cost. It's no real barrier to entry. You don't have to go fill out some documentation to buy an ETF. It trades just like a stock. So that's always good.
I think there's going to be a shakeout in the ETF industry because there are, I heard the other day, there's more ETFs than there are stocks now. I mean, and they're not free. It costs money to launch an ETF.
Yeah. It's definitely, it's been a real learning curve for me. But
you're writing checks.
Yeah. I mean, it is an expensive proposition, but there's some really big firms that can really, sort of navigate those and get some economies of scale. But what I feel is that there almost is a shakeout constantly underway because, I don't know what the current ratio is, but maybe 3 opened, 1 closes, 3, throughout the year. So there really is a lot of attrition in the ETF space because, it is expensive. But then also I can't help but feel like all of the private funds out there should see some value perhaps into converting. We've already seen it with the mutual funds, which are public, but they're not quite as, I'd say, accessible or efficient as ETFs are. And they have, capital gains distributions or distributions once a year typically. So there's real advantages to the wrapper, they call it, that an ETF provides. And when somebody is over here accessing an active manager for 2% and 20% of profits, and then they can go over here and access an active manager for 59 basis points, starts to become really compelling. And I can't help but think that there's going to be more of the same and that it's only going to help the individual investor be able to access better managers, which is great.
I'm trying to end my interviews, Katie, with the one question, which is, what did I not ask you that I should have?
Oh, that's a good question. Well, just in terms of what's most exciting, I think that's often a good final question. And I have to be honest on this front that it probably is Bitcoin right now for me. And I try hard not to become, sort of perceived as just a Bitcoin analyst necessarily, because we do so much more than that. But we do cover cryptocurrencies on a weekly basis. So we're pretty deep into that market. And we think that technical analysis is a great way to understand them as an investor, as a trader. And that's a big breakout. We do have a big breakout as we come into year end here. I think there will be a better buying opportunity, some consolidation, maybe a retracement, right? Maybe that's an example of a little exuberance, politically charged perhaps. But the breakout to me looks really meaningful. And, in terms of an asset that's at this kind of cusp of going from something that was almost like a startup to now an established company type of progression. It is more established now, and more institutions are really taking interest. And I think there's just a lot of upside there, both in technical terms and otherwise.
Okay. So you're bullish Bitcoin.
Bullish long-term Bitcoin.
Katie, I know you're not feeling well. I really appreciate you taking the time. If I had a sinus infection, I would be in bed. So you're kind of my hero right now.
It's okay. It's the time of year. I'm probably not the only one. So, but thank you. Thanks for saying so.
I hope you feel better. Katie Stockton, Fairlead Strategies. Always a pleasure talking to you.
Same here, Ed. Take care. Happy holidays.
If you want to learn more about Katie and Fairlead Strategies, there's a link below in the description. And before you go, please don't forget, hit that subscribe button for our channel and check out my Global Macro Update letter. It's free. It's the best deal you're going to find this holiday season. Again, there's a link below. Thanks for watching.